Hi, I'm Rachel Gallegos with eXp Realty.
I'm Dan Moralez with Dart Bank.
And on this month's episode of How's the Market, we're going to talk a little bit about affordability when you're purchasing a home as interest rates go up. Because as we know, they're going up and there's nothing we can do about it. So,
yeah, the trend since the beginning of the year has clearly been, unfortunately, against us. If you take the average 30-year fixed rate mortgage in the beginning of January, it was probably in the low to mid threes. If you look at the average 30-year fixed rate mortgage now, you're starting to push the upper fives, even into the low sixes for some clients. So that takes a big bite out of affordability. It makes a big difference in the monthly payment, right?
Huge difference.
And what's happened to house prices during that period of time?
They're still going up.
Yeah, they haven't gone down, right?
They haven't gone down. And I wouldn't say that they're rising as quickly, but they're definitely not coming down.
Yeah. And so and we were just talking about this, there's so much information out there on social media, and everybody has an opinion about the economy and interest rates and housing, and so much of it is just wrong.
Yeah.
So it's, part of us doing these videos is to hopefully help educate you from people who are really true experts in the marketplace. We are in the streets day in and day out, and we're seeing what's going on. I would say that I kind of view it more as kind of a leveling off.
Absolutely. It was definitely needed, right?
Absolutely.
We want, we want things to cool down. It was not sustainable.
Absolutely.
It wasn't enjoyable. So, even though the high rates don't feel good in the moment, it, ultimately our
well, when you
housing
look at
market
it, like historically, even a rate that's in the upper fives to low sixes historically is actually still very cheap money.
Yeah.
I can think of several years, this is my 31st year lending, I can think of several years where if I said, gosh, I wish I had a 30-year 6% rate to sell, I would be doing like flips, because I would have had a line of people out the door to take that
For
money,
sure.
right? So it's just, I think the last, probably 4 to 5 years in particular, the last two, we saw these really crazy low interest rates, and that, seems really, really good. It's really nice.
Yeah.
It feels good to borrow really cheap money, but honestly, that wasn't sustainable either.
It was partially artificial, right?
Oh, totally. That was the government manipulating the market. Now the government's manipulating the market the other direction. So the pendulum's kind of swung the other way. So what do you do as a would-be home buyer in light of an increase in interest rates? I always like to tell clients it comes down to monthly payment, right?
Yeah.
Because most folks can tell you what their monthly payment is, but they don't necessarily know what the interest rate is on the mortgage that they have. So it really comes down to monthly payment, budget, and what can you afford. And when you look at what you can afford, how much house can it buy you? That number can vary a little bit depending on things such as interest rate, down payment, what other debts do you have? There's some creative structures that you can use to say, gosh, maybe we take some of the money you have for a down payment and maybe we put a little bit smaller down payment into the property, and we use some of those funds to reposition debt.
Yep.
Because it really comes down to monthly cash outlay. Right? If you say, I'm comfortable with a monthly payment of $1,800 or $2,000 a month, maybe that doesn't get you quite as far as what you'd hoped. Well, can we maybe reposition some of your debt so that that monthly payment is still very doable for you when it's all said and done? It's one option.
Yep.
Sometimes people are getting a little more creative when it comes to how you structure a transaction, let's say with a seller, where the seller maybe potentially help you do a buy down, where you buy down an interest rate.
Yep.
And you can lower your monthly payment that way. Instead of trying to negotiate price, which I still don't know that you can negotiate price a ton in today's market.
It's still tough to negotiate price. I think we're at a point where we're not necessarily negotiating below list price, but we're not going quite as high above list price as we were. So.
Yep. So you can still get creative with loan structures where you can get that monthly payment where the overall sum of what you're paid out on a monthly basis works. I just had this scenario with a client where the client was buying a condominium. They were going to do 20% down, and they were stuck on having to have an $1,800 a month payment. Based on all of their numbers, it wasn't doable.
Yeah.
So instead of doing that 20% down, we did 10% down, paid off a car and some credit cards, and they actually ended up with a better monthly cash outlay doing it that way than what they would have if they would have done it the way they wanted to.
Well, and having a lower debt to income ratio can also give you a lower interest rate,
it
correct?
benefits. It can benefit, like in a case, especially if somebody has mortgage insurance, it can
Yep.
benefit them. It can benefit in being able to get the loan approved that
Yeah.
much easier. And there's really a number of creative ways that you can structure a loan. Whether, like I said, whether it's buying down an interest rate, and when you look at buying down a rate, there's a couple ways that you can do that. You can buy the rate down permanently. You can buy it down temporarily.
Yep.
That's a different episode, though.
Yeah.
But there's some creative ways. One other way that sometimes you can look at buying a property and benefit from is assumability, right?
Yeah.
We talked a little bit about that too.
Yeah, it's definitely something that we don't see a lot of, and it's essentially right. The seller has a government
Typically,
loan of some sort.
FHA.
Yep.
So if you're a seller and you have an FHA loan, a VA loan, or a USDA RD loan, you have a mortgage that is typically what they call assumable. Now, I'm going to tip my hat to Rachel because you actually asked some really good questions about this, and I would say most agents are not familiar with this at all.
Yep.
So it just speaks to your expertise.
Yeah, it's an extra
in being
tool
on
in the
top
toolbox,
of,
right?
Being on top of stuff. But what assumable mortgage is if you are a seller and you have an FHA, VA, or RD loan, there's a good chance that you have an interest rate that is really low. For many of you who've taken those loans in the last couple of years, you could have a 30-year fix that's in the 2s, maybe even in the 3s. A would-be buyer of your house has the ability to take over or assume your mortgage. So that makes their house more marketable,
Yeah,
right?
absolutely. As an agent, if I know a seller of mine has a mortgage that could be assumable, I'm going to market that property that way. So if I've got, or if there's 20 buyers in the market in that price point looking at it, well, now saying it's assumable, maybe I've added 20 more buyers because buyers that maybe couldn't afford it because their interest rate. Yep. Other agents can now see that and say, "Hey, let's take a stab at this one."
It makes their property that much more desirable because somebody could potentially take over your lower interest rate. How it works. And this is really a quick, simple kind of summary. But how it works is, let's just say you owe $200,000 on your house, and maybe you sell it for $300,000. The buyer of your property has to be able to pay the difference between what you're selling the house for, in this case, the $300,000, and the $200,000 that you owe. So as long as the buyer can pay that difference and they can qualify to assume your mortgage, they can actually take over your payments, your interest rate, and that mortgage, and they are able to secure that lower cost of money for the remaining term of your loan. So it's something that typically you'd have to work with your loan servicer on those details. But if you're thinking of selling your property and you want to know how that would work, connect with Rachel.
Yeah.
She'll work with you to get connected with your servicer and help make sure really you get the maximum exposure for your property, because that's kind of a big deal. To have somebody be able to take over
Absolutely.
2 or 3% interest rate when interest rates are higher.
Yeah.
Especially for somebody who's maybe selling another house and is looking at buying your property.
They've got the equity to be able to take those funds and bridge that gap.
It makes it that much more affordable. So, when it comes to affordability, the big part, I guess we really want to impress on everybody is that it really takes a team of experts that know what they're doing to make sure that you don't miss an opportunity to make your dreams of home ownership come true or to maximize the profit you get on the sale of a property. It really comes down to making sure you have the right team of people, Rachel and I, working for you, to make sure that we don't miss an opportunity for you. Because if we didn't know about these things, there's missed opportunity or potentially greater expense that you can incur because you didn't work with us. So we don't want that to happen to you. Make sure you reach out to us, and we'll make sure we take great care of you.